Hello, my name's Benjamin Chong, and I am so excited to be with you on this fine Tuesday afternoon here in Sydney as we're helping founders from across Australia and New Zealand learn more about getting checks from angel investors. We'll be starting in just a moment, so buckle in and get ready for a fun ride as we hear from Brendan Hill, Cheryl Mack, and Maxine Minter. Angel investors can be a valuable source of capital to take your business to the next level, and they can provide more than money. In addition to providing the valuable financial capital that can be used to help grow your business, angel investors often bring a crapload of experience and expertise. And this can be invaluable as you set your business up for its long-term success. Angel investors write checks ranging from $10,000 to $200,000. And over the next few minutes, we're going to be exploring how do you find the right angel for your startup? What gets them excited when speaking with founders? And how can they help the founders that they've invested in? Now, before I introduce the angel investors on tonight's panel, I'd like to tell you a little bit about the Founder Institute. And I'm so pleased to be involved with the Founder Institute. I've been involved with them since 2011. And Founder Institute is the world's largest pre-seed startup accelerator. Over those years, we've helped launch 5,000 companies in 200 cities across 6 continents. And we help pre-seed entrepreneurs and teams build to traction and funding by establishing a critical support network of local startup experts that are invested in their success, and by providing a structured and challenging business building process that's helped our alum raise over $1 billion. Our next program in Australia, New Zealand, begins in March 2022. Try practice saying that a few times. And we've just opened application. So if you'd like to learn more, get onto the fi.co website. I'd like to welcome our very esteemed panelists tonight. First of all, we have Cheryl Mack, who is passionate about supporting the growth of the local startup ecosystem. Cheryl's currently working on her own startup, and most recently was the national head of community at Startup and Innovation Hub Stone and Chalk, as well as the general manager for New South Wales for the Australian Computer Society. Maxine Minter is the CEO of CoLab, where she helps coach, advise and train some of the greatest leaders, teams and businesses who are in the game of fast growth. She's also an angel investor, having spent a number of years working in Silicon Valley, but an Aussie. And coming online very soon is Brendan Hill, who's an entrepreneur, angel investor and growth marketer who loves all things startup, plus golden retrievers. He started angel investing after selling his e-commerce startup in 2016. Now, we're going to be dividing our little conversation today into 3 thirds. The first third is going to be about the angel journey, because I love, whenever I'm on a panel, when I'm listening to a panel, I love hearing about the panelists' stories. For me, that's what makes the panel interesting. So I'd love to hear a bit about the angel's journey. How did Maxine, how did Cheryl, how did Brendan come into this world of angel investing? Is it because they have a desire to be a shark-like VC? Who knows? You could ask me about that later. Or is it because they have a genuine desire to perhaps roll up their sleeves from time to time and support the founders that they invest in? So we'll have a little bit of a chat about that. Then we'll have some Q&A. We'll then move to making investments. How do angel investors find deals, opportunities? Do they land in their laps, or are they like hunters and gatherers? We'll learn about how they assess opportunities. Is it because they like the Comic Sans font, or they have a predilection for a particular colour? So we'll learn what piques their fancy and how you might be able to attract their attention. And then we'll talk about after the investment. It's all well and good. I love going to weddings. I think I'm going to my first wedding in a few months next week. But what happens the day after? So we'll learn about what happens post-investment from the perspective of angels. So we're hoping to cover the angel journey, the making of investments, and then after the investment. And of course, we'll take some Q&A. I'll note that there is a Q&A panel in your Zoom bar at the bottom, so please make use of that. And why don't we turn to Maxine? Let's kick off the Q&A, or my questions at least. How did you become an angel, Maxine?
Yeah, I started off actually thinking about it more as charity, which probably is a good approach when you're starting angel investing, just kind of cutting your teeth on learning about these companies. I am very lucky in that I grew up the daughter of an entrepreneur. So I got to watch my mother build businesses my entire childhood. And so felt very passionately and feel very passionately about supporting entrepreneurs as they go up that scale journey, finding true believers and kind of co-conspirators, if I can use that term, in the earliest stages. And so the first check I ever wrote was into a company that I wrote the check because I just believed in the founder. I knew nothing about the product space. I was probably the dumbest money on her cap table that's possible, and just really wanted to see her be successful. Unfortunately, she wasn't. Her company is now gone to zero. And I didn't think of it as angel investing at the time, but I really learned a lot about the kind of scale journey and the real challenges of getting a business off the ground in Australia in 2016. But I will say the landscape has changed quite a lot since then, but very grateful to have written my first check there. The first kind of proper check that I wrote as an angel, though, was actually over in the States.
Right. Okay. Fantastic. And what would you say has been your big lesson? You made mention about the whole scale journey, and of course you spent a lot of time in the fast growth world. What has been one of the key lessons that has stayed with you since your first investment?
Wow. I think one of the enormous luxuries and enormous privileges of being an angel investor is you get to learn constantly. You have this privilege of having a front row seat to some incredible founders building some incredible things. So you're constantly learning along that journey. Everything from how to think about an investment through to how to support that investment and that founding team as they build. But I think the biggest one actually is the importance and the challenges of optimism, in that for lots of people, for lots of founders that I meet, I look at them and I can absolutely see how they build that billion-dollar company. I can get really excited about the journey that they're on. And knowing that the nature of this asset class is that most of them won't build that billion-dollar company. It's an outliers market and an outlier game. And so having to train myself to be optimistic and realistic at the same time, which I would say is a work in progress. I don't think I have nailed that yet, but if I can cheat and say my biggest lesson is a continuing journey, a continuing lesson on finding that balance on a case-by-case basis between optimism and realism.
And is that the optimism and realism of your mind and of your being? Because you made mention when you meet with some of these founders, they're pitching. They're generally positive when they're pitching. course, you might not see them as the ball of sweat, or the pool rather of sweat gathers before they pitch or after they pitch. But how about of the founder?
Is my optimism about the founder, or my optimism about what I can see they're building?
Both, I think.
Yeah, I would say my optimism is about both. My optimism is also about what the future looks like, because the nature of angel investing is you're building, you can only really see the value, or often only see the value many years after you first write the check. Before that, it's quite opaque that it's actually going to work. And so optimism about what a market is going to grow into, optimism about a founder's ability to meet that market, optimism about customers' excitement about that product. I invest behind two theses, one being the automation of services, which has a couple of layers to it, and the other is a management team thesis. So I have a view of a certain features of management teams that I think make them uniquely successful to build those outlier companies. And so in both of those categories, I find myself getting very optimistic about a particular founder's ability to scale with an organization, and then having to check my optimism against the reality of how difficult it is for someone to personally grow at the pace of one of these companies.
Okay, thank you for sharing. And for founders on the line, I think Maxine has dropped a couple of hints there. She's spoken a little bit about her investment thesis and what you might need to do, if you like Maxine and what she's talking about, to get her attention. Interesting. Thank you so much. Let's turn to Cheryl. Cheryl, could you give us a little story as to how you became an angel investor?
Yes, absolutely. My story is a little bit of a funny one, and it also involves Brendan, who's here today and finally got on our call with us. Welcome, Brendan. So yeah, I was that kind of like accidental angel because I wasn't really planning on being an angel investor, but I've always worked in the startup space and have always been super supportive of founders. And so when one founder one day came to me and said, "Hey, like you're really good at marketing. Can you come and work for us? But we don't have any money to pay you. We'll pay you in equity." And I was like, yeah, that sounds good. I mean, it's not like I'm investing my own money. I'm just going to help a startup that I like. And so I was like, yeah, cool. Sounds good. And then another one asked me, and I think I was doing a couple at the time when a startup that both Brendan and I are advisors for, that founder came to me and was like, "Hey, actually, he didn't even come to me. We were just talking one day, and he was like, yeah, we're just like, we need like an extra 20K to close our round, and then we can get back to running the company." And I was like, oh, well, like if that's all you need to close the round, like I could do that. And then it happened again. And I was like, shoot. I think I might have become an angel investor. So I just called up some of my angel friends. I was like, guys, I've already invested twice. What do I do? And what they told me was really interesting. They said, actually, I can't remember who it was. One of them said this. They were like, well, the good news is that if you stop now, you are definitely not going to lose any more money. But the bad news is that you will definitely lose the money that you've already invested. And I was like, okay, what's option 2? What's behind door number 2? And they're like, well, if you keep going and make some more investments, you'll definitely probably still lose the money that you've already invested in those 2 companies, but you might have a chance at making it all back on one of the next 5 to 10 that you do. And I was like, I choose that option.
That's very cool. That's very cool. And could you share then from that first investment that you made, which was almost the accidental investment, the sweat equity one, what has been one of the lessons that might be helpful for founders today?
I think in my early days, I over-indexed on the product and opportunity space and not enough on the founder or the management team. And I really look for that now. Like I've tried to train myself, like Maxine has as well, to pick up on those cues and what I look for in a good founder. They don't necessarily have to tick every single box or be the perfect founder, but there needs to be something there that makes me feel like they're the right person for this problem. They're the right person that is going to be persistent, but also coachable, and a little mix of like overflowing optimism, but also a healthy dose of realism. So it's this kind of balance. And yeah, I think I've had to train myself as well to look more so at those traits with the founders, because I can get very optimistic and excited, like, oh, I've experienced this problem. Like, this is a huge problem. It's awesome. Like, this is definitely going to win. But then it's like, no, but will the founder actually be the right person?
Right. So a magnifying glass onto the capabilities, experiences of the founder and their team.
Yeah.
Cool. Thanks, Cheryl. We're going to turn to Brendan. And Brendan, love to hear a little bit about your journey. How did you get into?
Yeah, thanks, Ben. Thanks, Ben. Great to be here. Hi, everyone. So I got into angel investing in April 2017. I remember it quite well. It was level 30, Australia Square. And there was a small startup called Grow who were raising their first round of funding. So they billed themselves as a disruptive fintech that were looking to change the face of superannuation in Australia. And I was invited by my accountant, who was actually doing their accounting, and got them the ESIC status. I didn't know what ESIC stood for or what it did, but it's become one of my favorite 4-letter acronyms over the last 4 years. So we went up to level 30. It was alternate serves of salmon and steak, very well done, nice presentation on the TV. And I thought, wow, this angel investing is pretty amazing. I get to go to free lunches, talk to founders that are looking to change the world, and hopefully get a fantastic return, just like Atlassian did, which listed, I believe, the year before. So I didn't have that much knowledge of what angel investing was, read a few blog posts. It was before Jason Calacanis's book had even come out. But luckily for me, Grow did very well. 3 months ago, they just raised their Series C, led by Airtree, with $20 million. And the ASX also invested $10 million. So it was a fantastic first intro into angel investing. We've had 2 liquidity events since. So I've been able to recycle that money tax-free, which is fantastic because of the ESIC, Early Stage Innovation Company Initiative, which is fantastic. And that's something that can make your angel investors very, very happy. So it only costs $2,000 to do the self-assessment. So that's something that I would definitely recommend. And now I work with 1013, and I have Australia's largest AngelList syndicate. So looking at different high growth startups from around the world, it's a very exciting space to be in.
Very good. Thank you, Brendan. And what's your biggest lesson?
My biggest lesson is that great investments can come from anywhere. And you only have to look at Melanie Perkins. She was teaching at the University of Western Australia, teaching Adobe Photoshop classes. Went to an event, I think the West Tech event that's actually on next month, and Bill Tai spotted her there in 2011, and the rest is history. And back in 2019, I met a startup called ScalaPay, and they did before buy now, pay later for the Italian market. One founder from Combank, one from Airtasker, one from Prosper. And they had no Australian money, no one would invest. So they ended up moving over to Italy. And 3 months ago, Tiger just led their Series B with, I think, $100 million. So, the Australian ecosystem unfortunately missed out on ScalaPay, but yeah, just goes to show that, great deals can come from anywhere.
Thank you very much. Great founders, great deals from anywhere. Thank you very much. Now, we're about to move on to this next third of making investments. But before we do, there are some interesting questions that I was hoping that we could get answers from. So this is going to be some quick fire answers. And as much as you're able to share, you made your first investment a couple of years ago. I think you said 2016, 2017, Brendan. How many angel investments have you made since?
So I've done 33 investments overall. So that's a mix of syndicates and proprietary deal flow going direct with the companies. And now I'm in a fortunate position. I work with 1013, Steve Baxter's syndicate up in Brisbane, and I syndicate deals through his platform. So these, the last deal we did was a company that came out of Y Combinator called PayHippo, and they provide SME loans in less than 3 hours. So we did 500K US into PayHippo, for example, and now I get to help some great founders solving a big problem on the other side of the world, which is super exciting.
That's cool. Thank you, Brendan. Maxine, how many investments roughly would you have made, or a range that you'd be comfortable with sharing?
Yeah, that's a good question. I haven't counted them out. I think there'd be somewhere in the range of 15 to 20.
That's cool.
Most of them, I've only invested in 1 or 2 syndicates. I try to invest direct onto cap tables because I really love partnering with the founders. So that changes the way I invest a little, but yeah, I should count that. That's a number I probably should know.
Okay, but it's quite a few. You get quite a few monthly reports.
Yes.
Okay, very good. How about you, Cheryl?
I get hundreds of monthly reports, not because I've invested in hundreds of companies, but because I tell everyone to add me to their investor update list. I actually have a folder for it now, which I scroll through on Sunday nights. I have done 19 investments in startups, and that is a mix of syndicates, direct, and something in between, which I'm calling like private syndicates, where like Brendan and I just get together and we create a little trust between us to invest in a startup. And I am also running a syndicate so that others can invest alongside me. So I'll be hopefully running deals that I'm investing in through that moving forward.
Very cool. And then 2 other quick questions. So if you had to quantify, Cheryl, the amount of hours that you spend a month in investing or helping the startups that you've invested in, what's the range?
A month. It's probably like at least 3 to 4 hours a week.
3 to 4 hours a week. Okay.
Yeah.
That's cool. Maxine?
And that's like, oh, yeah. Go, Maxine.
Yeah, I think mine's probably the same. I budget 5 hours a week for it. And some weeks it's 10 and some weeks it's none. I think, as Cheryl just mentioned, I also run syndicates on AngelList and hopefully in Australia soon. And that really makes a big difference, because if you're closing a syndicate and you're in cat herding mode, that's very easy to blow out that 5-hour budget. Whereas sometimes, I haven't spoken to any interesting companies recently and I have a nice little break. So it's lumpy. It's definitely not consistent.
Okay. Thank you, Maxine. And how about you, Brendan?
2 days a week, Ben. Whoop. 2 days a week.
Okay. 2 days a week. Very good. And then perhaps this is a good question for you, Brendan. Charlene's asked, how much money does one need to be an angel investor? This is a little bit like, how long should my shoelace be, isn't it?
Yeah, well, I'm not sure, Charlene, if you know about the investor laws in Australia. There's something called the Sophisticated Investor Certificate. So you need to have, to get into most startup deals or syndicates like 1013 and Cheryl's syndicate, Aussie Angels, you need to have consecutive years income of 250,000 or more combined with your partner, or assets over $2 million, I think it is.
Not combined, Brendan. It's individual, it's not combined.
Oh, really? Okay. So, I mean, the bar is quite high, and there's a lot of groups that are trying to change this because, I mean, at the end of the day, it's taking away dollars from innovation in Australia. And I mean, to get into funds like, Airtree, Blackbird, Right Click Capital, it's that same sort of test that you have to pass. But if you do pass that, you can usually get direct on a cap table for about 25,000. If you're bringing a lot of value to the table, might be like Cheryl, who's got the biggest network in Australia, you might be able to negotiate your way down to 10K or something smaller. I've done that as well because I like to have a pretty diversified portfolio. So I've got a couple of sort of $10,000 investments at the pre-seed seed stage to see which companies start to hit that inflection point, and then I can, double down harder in the later rounds as well.
Thank you. And thank you for sharing some of those numbers, because it does provide a bit of context. Shall we change gears into the making of investments? We've been through a bit of the angel journey. shall we change gears into the making of investments? Brendan, how do you find deals? You said you find them everywhere. Good deals could be anywhere. How do you find your deals or opportunities?
Yeah, I've definitely been working on my proprietary deal flow over the last couple of years. And, it links back to that first story I told about Grow Super. So now I'm getting referrals from founders that I've invested in before. So Grow Super, unfortunately, they started with 4 founders. 4 years later, they're down to 1 founder. So I've backed, even though they're going very well. So it's definitely a rocky road in the land of startups. So I backed one of their founders' second startups called Together AI. They're building a digital company, digital compass for families to navigate their growing up journey online. Repeat founders, look at accelerators as well. Obviously, Y Combinator that I talked about for the PayHippo deal. Angel List, building out that US network. Talking to the funds in Australia as well, getting relationships with those guys, going to angel events. There's a great angel event called 361angels.com, which has some great deal flow. There's just so many ways to get deals. It's fantastic. I think last thing to point out is that because our ecosystem is still maturing, everyone's still pretty friendly. So, angels will share deals with each other. Really looking forward to seeing how Cheryl's new syndicate shapes up, because there's some fantastic deal leads that just want to share their deals with others, which is great.
Yeah, thanks for that. And I've been fortunate to have been an angel as well as a VC manager, and I'd say having a spread, having a variety of exposures to different businesses is really important, because with every investment that I've made at the time, I thought it would go to the moon and beyond. Of course, sometime later I find out maybe it mightn't even leave the Earth's atmosphere, but that's okay, because there are a number of other companies in the portfolio, and taking that portfolio approach sounds really sensible. Let's talk about the assessment of opportunities. Who wants to take this? Cheryl, would you tell me, you said that you've taken a little more care now in assessing the founders. What do you do? Do you put them through some kind of psych test, or you give them play mind games? Or...
No, we definitely don't play mind games. No, try to be as founder friendly as possible, while also making sure that I can do the evaluation that I need to do. But most of it's behind the scenes. I think the founders that I evaluate probably wouldn't necessarily know so much of the outside stuff that I do to vet them. I do look for founders that are coachable. So I like to see founders that will at least listen and take things in. They don't have to follow anyone's advice, including mine. And I try not to give advice, only experience. But I need to see that they can listen. What else? How else do I evaluate founders? I think it's important to know if you're going for angel checks, all of us have our own kind of thesis, as Maxine was talking about, in terms of what we invest in. And it's good to find out possibly ahead of time, because a lot of us, the 3 of us, at least here on this call, are pretty open about what we invest in. And so if you just do a tiny bit of research ahead of time, you'll know whether you fit into one of those categories or not. For example, I will never invest in anything to do with biotech. I try to stay away from deep tech, like med tech stuff, anything to do with medical devices and anything to do with hardware. It's just not really my area of expertise. So things like that, it's good to know ahead of time, because that's an immediate filter that I'll put on. If something comes through my pipeline and it's in one of those categories that I just won't invest in, then I'll put that kind of immediate, like, no, that's just not me. I might send them to someone else if I'm like, this looks pretty cool. But for the most part, I'm probably not going to send something to someone if I haven't actually met the founder and thought, like, this is actually worth taking a look because it's in your space. So that's good to know, first of all. And then when you actually get on the call with me, I will ask questions. That's all it is, really, asking questions until I get a sense of who the founder is. And if I'm excited, I'll usually give them a little bit of homework and say, let's check in next week. Because usually there's something that they haven't done. Maybe their data room's not ready, or they haven't included any market analysis. So I'll usually give them a little bit of homework and then say, check in with me next week. And as long as they can follow through on that, then that's a good sign. I've made decisions really quickly. Like,
so what's the quickest decision?
Sorry?
What's the quickest decision?
Before I even met the person.
You had this feeling, did you?
That was an outlier because pretty much everyone that I respected had invested in the company. And it was kind of a matter of like, if this many people on my, like, I respect you and your opinion, and I follow you in my angel network had already invested, then I knew I was going to invest before I went on the call. But with the founders that I've made the decision like on the call, I've made the decision on the call with them, even on a first go. Usually that founder comes from a warm referral, and just because I make the decision on the call doesn't mean that I can't reverse the decision afterwards. So I'll still go through and do the DD and check in and make sure that all their kind of stuff is sorted out. And it could turn out that, oh, actually this isn't right. But generally, like I've made a decision on a call and then actually followed through and invested. Whether or not that's the right one and whether we lose money on that or not, I'll let you know. But yeah, I can move very quickly with very quick conviction. I am not necessarily the rule in the space. So you won't always, like, not all investors are like this, but I also, like Brendan said, my check size is very small. So I can't really afford to be faffing around and making founders spend a lot of time doing a lot of DD with me, because I realize that I don't invest enough to demand that from founders.
Okay, so there's a recognition of you want to make sure that they pass certain tests in your own mind, and if they pass enough of those tests, bang, you want to move.
Yeah.
Cool. Let's turn to Maxine. Maxine, can you think of a recent investment that you've made? You don't need to name the company unless you wish to, but could you walk us through the steps in a couple of sentences?
From how I found the deal all the way through to check?
Yeah, because I think a case study is always a really helpful way for us to contextualise how did someone manage to get Maxine to part with her dollars.
My most recent investment is probably a bit of an outlier in terms of process. So I think probably the more indicative one is one I did recently into a company called Own Home, which I'm not sure if you're familiar with it. They are a rent to buy offering for Australia for homes. So for people that don't have the deposit requirements to be able to buy a home, you can rent from them for a number of years, earn credits in the property, and then purchase it in a normal with a normal mortgage. So my process there was, as Brendan mentioned, in our line of work, collaboration is key. The ability to partner with like-minded individuals to refer each other deals, have a really good sense of who around you can add value on cap tables, and what they're interested in investing in. So a contact referred me a deal because I have been very interested in the automation of kind of property services for a while. Have a bunch of friends who were early at Open Door and have watched that journey very closely along its really impressive trajectory. And so when I first got back to Australia, I was kind of very open about discussing the theses of what I thought was possible in Australia. So when the Own Home team, they were early at Wise, and then also James is a consultant from Bain in San Francisco. So when that opportunity came up, he referred it to me. He was in the middle of closing his round, and I essentially pleaded with him to let me in for a very small check just to get some exposure on the cap table, to start to get an opportunity to see how the company is building over time. So actually, that's probably not a very good indication for the majority either. So he didn't pitch me, so to speak. He didn't give me any a deck. We went for a long walk. I already had a number of theses about this ecosystem, and what he's building is very similar to a similar product in the US that does an exceptional job. So I'm very familiar with the business model, very familiar with the risks, very familiar with how I think it's going to play out and I've thought a lot about how I think it's going to plug into the Australian market. So it was about me finding a founder who I think is exceptional, who's going after the problem set that I've thought a lot about, so that I could move, in a matter of minutes, once he let me on his cap table.
Okay, thank you. So it's almost like you had, in that scenario, you had a hunch or you had a desire to get involved in that space. And this happened to be the right peg, if you like, that filled that space. And there wasn't a lot of negotiating because the deal terms had already been set, it seems, and you asked to be let in, and I assume have invested since.
I have, yes. I wired funds a couple of hours after I met him. I think for the benefit of the audience here, which I gather from the chat, most of them are building companies, not investing in companies. I want to stress how outlier that dynamic is. The vast majority of companies I have invested in, it follows a very different process, which is either I knew them already and or they were referred to me. Then, similar to Cheryl's process, you either take the intro or don't take the intro based on whether you think you can add value on the cap table and or you think it's a good fit for your thesis. And then you will meet with them, have a chat, explore whether you think there is founder market fit, there's a big enough opportunity that they're chasing, their business model is interesting and or kind of proven out and or doable. You think that the competitive landscape allows for long-term value creation, not long-term kind of value compression, et cetera, et cetera. There's lots of questions we're asking ourselves about the particular space that the company is chasing based on the hundreds of deals we get to see, every single year, sometimes even thousands, depending on your deal flow. And then having a conversation with that founder to explore with them, do we think that you can chase this problem? Is this a problem worth chasing? And if you successfully chase this problem, is the upside worth the risk that you are taking and by kind of corollary that we are taking along the ride? And do I think I could be helpful? For lots of angel investors, they're just wanting to kind of be along for the ride. But for me, it's very important to me that I am smart money on the cap table, because frankly, my check is so small, I'm not going to add a lot of value from a capital perspective. So looking to kind of come onto cap tables, partner with folks and help them, sail through their next funding rounds, through building fantastic companies. And so that conversation portion usually lasts for 1 to 2 conversations, and then I get to conviction, and then I wire money when you tell me to. So that's the more common arc. You just caught me on the last 2 deals I did were outliers. One had been a friend since business school, and the other one I wired after taking them for a walk along the coast of Sydney. So it's very unusual that that's the approach.
Brendan, you see a lot of deals. What tips would you give to founders wishing to improve their chances? Everyone wants to improve their chances.
That's a good question, Ben. I would definitely say you want to try and start the relationship early. I saw an interesting statistic the other day. The average founder-investor relationship now lasts longer than the average Australian marriage. So, for an investor to put a great deal of money into your startup, where traditionally, 90% of startups fail, you're going to have to, I guess, using another marriage analogy, you're not going to propose to someone on the first date. You need to get to know them over a number of months. So if you can get in front of people early, it might be at events, it might be just reaching out cold and updating them, but not asking for money straight away. I think that's a great tactic to use. And, the deal that I'm closing hopefully tomorrow, really young guy from Brisbane, when he first reached out, I think he was only 18, so super young. But, you know, he didn't ask for money on the first date, I guess you could say. You know, sort of told me about his idea, kept updating me as he built the team. Like Cheryl said, she likes to get on all these investor update lists. It's a great way to keep track. You can find the founders who keep doing what they say they're going to do. You know, have they got that relentless focus on execution? You know, are they growing fast? Do they have that momentum? I think momentum and how you show that is super important as well. And you know, you might be pre-revenue, but there's other ways to show momentum. A good example is Together AI that I mentioned. You know, they're just about to launch their app, but before they launched, you know, they had a 20,000 family wait list for the product. You know, they could show me their intercom bot where, you know, people were asking, you know, when will the product be released? I need my kid to use this product. They were getting, you know, 20 to 40 inbound messages a day. So there's a lot of different signals that you can show investors that, you know, will impress them. And I recently read a fantastic book on fundraising. I just put it in the chat for everyone. It's by a founder called Ryan Breslow, and it's got a fantastic title. Oh, it's blurring out, but it's just called Fundraising. And he founded a startup called Bolt.com in the US. That I invested in a couple of years ago, and he's grown it to a $12 billion valuation. And it's only a 50-page book, super short, but I definitely agree with 95% of the points that he's put in there. He summarizes it very well. So I think it's definitely a must read for every startup founder.
Thank you. Now, we've got some questions and answers, so I might give a few quick fire to you, Brendan, before then turning the questions to Cheryl and Maxine. Do investors prefer to invest in startups pre-revenue or after they're generating revenue? This is from Moshe.
I mean, in Australia, I found that investors like post-revenue startups, you know, a lot less risk, but I think you have to compare our ecosystem to the US ecosystem. They've had a lot more wins, a lot more publicly traded companies. They've got a lot more, you know, employees from, you know, Amazon, Uber, Airbnb that have had these big liquidity events. They can take bigger risks, and you know, the risk is more in that US culture compared to Australia. So I guess that's why you see a lot more deep tech getting funded in the US. You see the higher valuations as well. But I mean, if you can show traction in other ways, I mean, another example that I invested in Before Pay, that's actually IPOing next month. And you know, when I went in to meet Tarek, it was at Stone and Chalk, where Cheryl used to be head of community. And you know, I walked in, Tarek was in track pants and, you know, sweats, you know, just a hoodie. And, you know, it was pre-revenue. All he had was an Excel spreadsheet with 152 rows that they were plugging in as an algorithm. And, you know, the thing about Tarek was, you know, talking to him about his vision for the product. You know, he had 3 team members at the time. He was raising 1.3 million at an $8 million valuation. It was just the inevitability of success. You know, he's saying, you know, once we get to 150,000 users in 2020, we're going to roll out feature, you know, X, Y, and Z. And, you know, he's saying this working in Stone and Chalk with 3 people, but he just had that, I guess, inevitability of success. You know, I just wanted to be part of his journey. But I think as an investor, you need to be careful. Like, you know, there's people like Elizabeth Holmes that can really sell a vision, but there definitely needs to be something behind that. And that's what Tarek had.
Thank you very much, Brendan. Maxine, in terms of financials, what statements or forecasts do you look for from startups? This is a question from Katie.
I don't. So I invest in largely pre-revenue companies. Sometimes they have revenue, but at the kind of seed and below stage, revenue is only sometimes an indicator of growth. And so sometimes it's shared with me as an indicator of appetite, but what I'm really using that for as a heuristic for appetite for the market. So as Brendan mentioned, those kind of customer outreaches, those people banging on the door to get access, to the extent that I can get my hands on that kind of data, that's helpful. But given the stage that I invest in, if a founder gives me a financial forecast, I question whether they're allocating their time to the right things, because if they think that they can plan out for 3 years exactly how this is going to work on a like month by month basis, I think they fundamentally misunderstand the challenge that they're up against.
Especially when there's sense, like there's 2 BP. It's like, seriously? I have no idea how I can even get my normal personal budget to balance to the nearest $100. How are you going to get sense?
Yeah.
Second question for you from Daniel. How does a startup get in front of an angel investor, perhaps where they don't have the ability to have someone provide a really warm introduction or a connection?
Yeah, absolutely. So my first nudge is try really hard to hustle, because for most angel investors, they only look at warm intros just because of a volume game. That's not exclusive. You know, I've had people reach out to me on LinkedIn that I've followed up with. I've never made an investment through one of them, but so my strong recommendation is ask everyone you know to introduce you to everyone you know, even if you don't really know the person that you're asking to introduce you to the second person. If that's not possible for you, and let's be clear, for a lot of us, especially in Australia, which, as Brendan said, we're a developing market, we're definitely not a mature startup ecosystem. It might not be possible that all of us have people in the startup ecosystem or angel investors, or, well, like, to be frank, wealthy people in our network. Maybe we're coming from a life and an upbringing where we don't have wealthy people in our network. If that's the case, some recommendations I would have is cold outreach. Write a really thoughtful email to that person. There are so many tools where you can get people's email addresses, especially if they have some kind of company. Clearbit is a great one. It's free, it's plug-in for Gmail. Just go and scrape their email address, and then research that person and reach out to them very thoughtfully. I have cold emailed some ridiculous people in my time, and they've responded because I've spent a lot of time thinking about why I'm reaching out to them and why it's a good use of their time. Don't email them and say, hi, I'd love to chat about my company. When's good next week for a coffee with you? That's not helpful to filter that out from the other emails that we get. But, you know, I saw you invested in these companies. I love the thesis because of these reasons. I noticed that you are also interested in this space. Here is a tweet you tweeted in 2015 before you even knew you had Twitter. Yeah, I went deep and I really understand you and I really want to meet you. That's much more interesting to me. So unfortunately, if you don't already have those warm intros in your network, you're going to have to do a little bit of extra work, but it will pay off, because without that, you're often going to be filtered out at the email level. And don't hang out at people's offices. That's weird.
That is, I've had that before, and I'm thinking, oh, weird. This is really strange.
Yeah.
Ben, I might just add on to that. Maxine, another way that you can get those warm intros without having access to those people in your network is actually joining a program. So joining something like Founder Institute, joining an incubator and accelerator, you don't need a warm intro to join one of those programs. But once you do, then you have access to mentors who can make warm intros for you. So joining a program can be a really great way to get access to warm intros without having the network built in.
That's a top tip. Top tip, Cheryl. Is it better, from Charlene, Cheryl, to start to talk early to investors when your idea is not mature, or wait till it's a little more presentable before engaging in that conversation? Good question.
It's a really good question, because I think investors in general, whether angels like myself and the others on the call here, or VCs, love to say things like, it's never too early to come talk to us. The reality is that there is a too early to come talk to investors. If you just have an idea and it occurred to you in the shower last week, not so great. If you've been obsessed with something and a problem, and I really want to emphasize this, I'm less concerned about you having an idea and more concerned about you being obsessed with a problem space And if that's something that's been nagging at your mind and you're like, I really want to solve this problem, I've identified that there's a really painful problem here. And that's something that you want to go talk to an angel about, not necessarily to ask them for money, but to ask them for advice on how to approach potentially solving that problem. That's something that personally I would probably be open to. I would be receptive to if you were reaching out cold and did what Maxine said and wrote a very thoughtful email around why you wanted to reach out to me and speak to me about that problem space, because maybe I'd invested in a company that already tackled something adjacent to it, or something like that. That wouldn't necessarily be too early. But if you're actually asking for money from investors, then it is assumed that you're going to have something that is, to a certain point, worth investing in. So if you're still at that idea stage, it's probably a better idea to go through one of those pre-seed accelerators, incubators, programs, pre-seed accelerators like Founder Institute, that will help you get to a point where you can articulate what you're doing in a very clear way. Because if I get excited and I'm like, yeah, where is this at? You know, like I'm in. You sound like you're a great founder, and you turn around and go, okay, well, what do I need to give you? And I have to explain to you that I need to see your like subscription agreement or a term sheet or a safe note. Then it's probably going to turn a yes to a no.
What document are you often investing on? Are you doing a price round, a safe, a con note, Cheryl?
I've only done one con note in my 19 deals so far, and that converted. So really, to me, it was basically like a safe note. Everything else has been about 50-50 priced equity and safe notes. I don't necessarily mind, but I do know that there are investors that will absolutely only invest through priced equity. They won't do safe notes. And there's been a little bit of talk in our little tiny angel stratosphere recently about us getting burned on safe notes because of what Brendan mentioned earlier with the ESIC benefits. And I was the first one, about a year ago to say, it's fine. But then when it actually happened, I felt a little bit differently about it. So if you want to read more about that, you can read Rain Ong's Unsafe Adventures. If you just Google that, it should come up. So look, my preference, I'll take priced equity any day over the others. But if you're an exciting company and safe's the only option, then I'm not going to let that block me. But I do know that there are other investors that have a more hard line.
A bit different in that the vast majority of the deals that I do are in the US into American companies. So that ESIC benefit is not an option for me. I also do most of my investing on the West Coast, where the vast majority of the deals are safes. I have to add them up, but I would say like 80 to 90% of the deals that I've done have been on safes. First check in. For the second check coming in, they're usually converted into a price round. So often what happens is you do the safe on your first round or your earliest rounds, stack safes, or known as stacking safes, so that you don't have to pay for those legal minutes to get those deals done. And then at the point when you're raising enough capital that it makes sense to pay for those legal minutes, then you price it. So yes, having said that, in Australia, I have done one safe. No, maybe they've both been price rounds. So it's a different ecosystem down here in that in that respect.
That's right. And then one last question, and that is, will you invest in a solo founder?
100% yes.
Okay. Cheryl, yes?
Yep.
Brendan, yes? No?
Yeah, I think the sentiment around that's changed over the last sort of 24 months. There's been some great solo founders. Josh from Together AI that I've mentioned is a solo founder, and after being at Grow, where they had 4 founders, he said he's never going to have a co-founder again. So and in that book that I recommended, Fundraising by Ryan Breslow, he has a chapter about solo founders. He's a solo founder himself, and his rationale is that he'll just employ best-in-class people, heads of each department, and he's the solo founder.
Thank you very much. We are going to move to the third of our time together as we explore after the investment. How do angels help companies post-investment? And perhaps we can make this a little interesting. Post-investment, Maxine, if you want to think about what was the most surprising experience for you, Cheryl, the most disappointing experience? And it might not be the day after you've wired the money, it might have been like a year after. Brendan, you've given a lot of advice to people over time as an investor and a previous founder. Is there something you'd do differently?
Yeah, where my mind goes first is this funding market. What I have been consistently surprised by over the last year and a half is how quickly companies have grown. I've invested in one company that I invested in February 2020, Series A, and they just closed their Series C at a very solid markup. So that blew my socks off. It's a wild funding market out there. That's all I'll say. That's been a surprise.
Okay, that's your most surprising experience. And did you help that company go from A to C in a matter of months?
My perspective on angel investors are your best angel investors maybe help you avoid one pothole as a founder. So I hope that they would say I help them avoid one pothole, but ultimately it's up to them. They're the ones taking the risk. They're the ones building the company. They're the ones out there hustling. They're the ones raising the capital rounds. I mean, I can give them an intro, but that doesn't raise a round. And so I am hesitant, if not reluctant, to say I really participated in any of it. It's just me hanging onto their coattails, singing their praises.
Most disappointing experience. One of the first companies that I invested in, I was one of their earliest believers. They recently raised a round with a very prominent US investor, and I was given the opportunity to reinvest. And just based on my own circumstances at the time, I chose not to take my full pro rata amount, which means that I left some investment that I could have made on the table. I found out after I had made that decision and after it was done that in the new round with the US investor, I was losing my pro rata rights. And I felt pretty disappointed that the founder hadn't told me that, because if he had told me that prior to me deciding, I would have made it work to take my full pro rata amount because I may not be able to reinvest in the next round in the company. So I was pretty disappointed that that happened.
In my experience, I've sometimes been asked to hurry up to get into a round or hurry up and sign documents. And I'll admit that there have been times where I've hurried up and signed documents. I've forgotten to look at Appendix X, which might have the said pro rata rights or not. Yes, thank you. Brendan, something you do differently, particularly in relation with the founder?
Something I do differently. One relates to the SAFE question. I think I dropped out for that one. So invested in the seed round of a company, and at the time they were ESIC compliant. But by the time that SAFE note converted, unfortunately for me, they had too much revenue. I mean, fortunate for the company, they're going very well. Too much revenue, and they no longer qualified for ESIC. And this was my largest investment to date by a fair margin. So it was pretty disappointing to, potentially lose, 30, 40% on taxes at the eventual liquidation event. So it would have been great to understand more about, safes and how they can be unsafe.
Thank you for sharing. Any other comments from panelists about perhaps whether you've been a shoulder to cry on from a founder, or whether you might have opened the door to a founder or given them some feedback that was useful?
I always used to tell founders pre-COVID, if you ever need a place to sleep or a meal to eat, give me a call. And many a founder used to take me up on that. That was, pre-COVID. I think what's important to know is that investors are different. And while you've heard from 4 here today, this is not necessarily representative of the market. And it is good to understand what different investors can offer and what you're looking for in an investor. So, some of us do come with more than just money. Others are just money. And it's good for you to have an idea as to what you're looking for before you start reaching out to investors, because especially if you get on the phone with one of us one of the first questions we're going to ask is, what are you looking for in an investor? What kind of expertise or support or help do you want? And if your answer is, I don't know, or I just want your money, that's not really going to look super good for us, at least. But that could be the case for others. So having a sense of what you're looking for is really helpful for you as a founder when you start this journey.
Of the startups that you've seen angels invest in, how many have actually given a return?
Yeah, it's a great question, Daniel. I mean, I'm only 4.5 years in. So I guess the usual horizon for some kind of liquidity event is usually 7 to 10 years, even longer in some cases. I think Uber was 12 years. Palantir was 14 or 15 years. But I mean, in my case, Before Pay went from pre-seed to IPO in about 2.5 years. I mean, angel investors are always looking for some sort of liquidity event so they can recycle into the next great founding team. So with Grow Super, I've been lucky enough to have 2 of those. Some international funds came in and gave the pre-seed investors an opportunity to take some chips off the table. And I guess my thesis around taking chips off the table, very similar to Jason Calacanis. I think he says he takes 20% off at every opportunity. So it's been great to do that. I guess the problem with syndicates is that you really have to stay there till the end. I've never heard of any kind of liquidity event until exit day. So that's definitely another advantage of going direct. There might be some opportunities to get some liquidity, which is great.
AngelList is changing that. They've got transfers where you've got a secondary market kicking up around syndicates, which is, I think, a game changer for the angel ecosystem and for early stage founders because of that, because more capital gets less locked up for less period of time, means more capital flow into the ecosystem, which is very exciting.
That's right. It's good for all involved.
Yeah.
I'd like to take this question. How do you structure your portfolio? By vertical, business stage, founder personality?
I think it depends on the angel investor. I think Cheryl's mentioned this a couple of times with theses. So for those individuals, I think the first thing to name is it changes depending on angel, and then it also changes if you're distinguishing between angel and VC. So to be clear about that, what a VC is it's someone who is taking other people's money and investing it on behalf of those people into startups. That's a venture capitalist. And an angel investor is investing their own money. That blurs a little bit if you have syndicate leads, which is what Cheryl and I were talking about earlier, but broadly speaking, that distinction. So you can imagine if you're investing someone else's money, you likely have to make promises about the way you're going to invest that money. So you make promises about stage, you make promises about the way you'll come to the decision, you'll make promises about maybe verticals, founder personality, whatever demographic we're wanting to use to segment the enormous number of opportunities out there. And then for angels, just to round out that thought, it's very unusual. You'll get, especially in this market now with the number of capital managers out there in this earlier stage, it's very unusual you'll get a non-segmented VC unless you're Sequoia or Tiger or SoftBank and you just invest in everything at every stage with every kind of founder profile and return. In Sequoia's case, amazing profiles. In Tiger's case, question mark whether what's going to happen there. For angel investors, it's much less systemized because you're talking about individuals making decisions on an individual basis. So for some people, you might have an angel investor who's a thesis investor, a la myself. You might have an angel investor who's a generalist, maybe a la Cheryl and Brendan, with some restrictions. You might have angel investors who are investing for impact. So they want to see a change in the ecosystem. So it's not about what they think the ecosystem is going to do. It's what they want to see the ecosystem become. Other angel investors are just investing for returns. So they come in and they need to see that you're going to be 100x company over a 5-year period. Otherwise, it's not as interesting to them. So I'm going to underscore and amplify Cheryl's point earlier about really doing your research with the angels that you speak to. So for example, if you're a biotech company and you are pre-seed, it is not worth your time or the investor's time to go and speak to a D2C only investor who focuses on growth capital. It's not a good fit for you, and they'll probably screen your deal, not because you're not fantastic and you're building a cool company, but you're just not a fit for what they're after.
I'm good at technology, not business and sales. What would I do?
Find a co-founder.
Boom. How does he find a co-founder?
Go to university and then drop out once you find them.
It's actually like he sounds like he's kidding, but like not.
Pretty good.
Yeah. There's a great playbook by First Round Capital on co-founder dating. It's got a whole little booklet on it on like how to go about going out there and finding your co-founder. Having said that, if you're not great at marketing and sales, finding a co-founder through that strategy could be quite tough because you actually have to go and sell your vision to someone and bring them along for the journey. And as Brendan mentioned before, kind of marry them for the next period of time because you're going to be financially tied together for a long period of time.
Have you had an experience as an angel where you had very different needs of the company, presumably as an investor, v that of later stage investors, and what caused the friction?
My needs as an investor is to see that company do well, whatever that looks like. Like I feel like my needs as an investor don't necessarily really matter other than do well, make a return, increase my investment, try not to be evil. Like,
I will do my best not to be evil.
I'd say in my experience, it has been sometimes when secondaries, when there is perhaps a new investor who comes in and offers secondaries, which is the buying of existing shares so that people can take money off the table. Sometimes there can be a tussle between the very early investors who first help fund the company and perhaps a slightly later stage investor who's written a larger check but wants to have a cash on cash return for their investors. And you can imagine the earlier stage investor, often an angel, saying, look, I trusted this company when they were not even born, while they were in their mother's womb. I helped do all these things. Now can I take some money off the table? So that's where I've seen a little bit of conflict, but it's less to do about the company, because everyone wants the company to be successful, and more to do about who should take more or less money off the table.
Yeah. That's a great example. The other obvious one is when CVC, corporate venture capital, comes in as an investor, which for the folks in the room, what that means is for some companies, large companies, they have a venture capital arm that's out there investing in companies that are strategic for them. So there are some circumstances where what is strategic for that investor is not overall value creation for the other investors on the cap table. I've seen that happen quite a few times. Very luckily, that hasn't happened to me. But if you get stuck on the wrong side of that as a pre-seed angel investor, that you're pretty much counting that one as a zero.
I wanted to thank our panelists for taking part in today's session. To Maxine, all the way from Silicon Valley, we've got an amazingly clear fibre optic line. To Brendan Hill, are you in Brizzy?
No, I'm in Sydney.
Sydney, okay. You're looking very warm in that T-shirt there. Fantastic. Thank you for joining us and giving us your wisdom. And of course, to Cheryl Mack, thank you for taking part in today's panel. Please hit up fi.co, the website. And thank you for joining this session that's been hosted by the Founder Institute in Australia and New Zealand.